want to get into here is some of the more advanced trading techniques that I'll show you here. But the main focus of what I want to get into here is how to get into a trade, and if it reverses on you, how to get out of the trade. Before I want to cover that aspect of this whole experience, I want to actually get into, well, what are covered calls, and what are some kind of spreads that we can potentially what are spreads like? Because you guys are used to getting into trades in one direction, and typically it's only usually naked calls or naked puts. And from a risk standpoint, as you guys are already aware, um, if the contract expires, then you could potentially lose all of your premium, and we don't want to do that. That's just a bad thing, and that's the worst part. When I first got into trading options, it was the part that I hated the most. If I would get into a trade, it would reverse, and then I'm sitting there, and I'm praying, and I'm saying to myself, "Oh man, I really hope this thing goes back up." But then you have two operating factors that prevent you from actually doing anything. The biggest operating factor is the fatal loss of these contracts. The fact that these contracts expire worthless every single day that passes, you're in a situation where if the trade continually keeps going sideways, or you don't get out, meaning you don't get out in time, by the time expiration comes around, the $200 call that you got into is end up worth it's worth like $20, and you end up losing all of your premium. So you don't want to, that's the worst part for me. So the other aspect, and the thing that I want you guys to be cognizant of, is just like there are when you're buying and selling shares, options can be bought and sold. So, for every option that you're buying from somebody else, someone is selling that option to you, right? And because of the position of I'm buying a call, I'm spending $100 on this particular call, and then if the equity that option is tracking goes up exponentially, there's potentially unlimited money you can get from that, right? So, but your risk is capped at the premium that you spent for that particular option. Your risk is capped at the premium. But for the other person that's selling you that option, their risk is unlimited. So from our standpoint, when you actually start selling premium or selling options, there is a potential unlimited risk if that thing keeps going up. Just like how when you short a stock, if you take because there's when a stock goes up, right, it'll keep going up, the value will keep going up. But if you're taking a short position, and the stock keeps going up, you can have an unlimited potential loss when you take a short position. Like if the stock just keeps going up into infinity, there's an infinite potential of loss how high the stock goes up if you've taken a short position, or basically a bet that the stock is going to actually go down in price. And these are some of the more challenging things that when I first started trading stocks years ago, these are some of the more challenging and complex things from my understanding. But with options, there's a whole new element to options. When I started getting into spreads and researching spreads, and I paper traded the crap out of it for weeks and weeks and weeks, trying to figure out all the different spreads you can potentially do, all the different spreads that you can set up, the verticals, the iron condors, the back ends, the diagonals, the calendar spreads, just really playing around with them and understanding them. Um, Something occurred to me when I started looking at all of my position statements, or the components of the spread. I noticed one thing, that the short leg of the contract always was a higher value than the long leg. So it occurred to me that if you're selling contracts, or if you're selling an option, there's a couple of different factors that are working in your favor. The theta loss alone is the biggest component of an option stack that gives you the ability to, when you're selling something, to keep getting money, even if the stock does absolutely nothing. the stock that it's tracking, let's say Apple is at 110. If you buy a call on Apple to go to 120, let's imagine that contract that's worth $100 expires at the end of the week. Every single day you buy it on Monday, if Apple stays 110 from Monday to Friday, every single day that passes, the premium is going to be worth less and less and less and less for one main reason, and that is theta. And when I saw how these things were stacking up in my spreads, I said, well, we can probably use this to our advantage. And I thought to myself, why is nobody really teaching this? Why is nobody telling anybody that you can actually convert something that reverses on you, and then come out with with potentially a profit if it does reverse on you potentially. Like, these are just so many more tools than anybody ever unloads out there or puts out there. So I decided, I said, you know what, I'm gonna come up with a mechanism for doing these kind of things. But before I want to get into those, I want to actually get into um, the concepts of what. Let's start with vertical spreads. So I'm going to start sharing from my touchpad here. Let's see. Where's the whiteboard? Okay. So let me go back here a little bit. I was playing around with this stuff. All right. So, okay. All right. So the first thing I want to kind of showcase to you guys here is, what vertical spreads are. Okay, vertical spreads are some of the simplest types of spreads that you could potentially do. And what that's composed of is it's composed of buying a spread or buying a call and selling a call. And it's all dependent on price action. Okay, so price action is basically, all right, let's imagine that this price action on top, this is less price, right? And this is more price. So if this is Apple, forgive my chicken scratch, if this is Apple, then this direction would be if Apple's going up, this prediction is if Apple's going down. Okay, so let's go back here a little bit. All right, so when you're actually buying a call, I want to show you here really quickly in my thinkorswim. All right, so let's go really quickly to an option stack, and I want to go to a single option stack, and this is Apple's option stack. I want to start with Apple because it's pretty straightforward. It's pretty simple to understand. First, I think we covered this before, but the first more important things for me that I want to look at when I look at any option is the volume. How much volume that option is being traded with, and how much open interest it is. So, for example, the 109 right here, right? Might not be able to see it, but on this line item right here for the 109 strike on Apple, we can see that 15,139 movements occurred. That's both buying and selling. I hope you guys can see that pretty clearly. And then there's open interest, which means that the open contracts that are actually out there on this particular option, even though 15,138 were traded, up till last Friday, there's only 579 of them that are actually open. So the biggest thing that I want to look for in terms of options from a naked standpoint, whether that be a call or a put, would be how much volume there actually is. Because just how I said, in order for you to buy a contract from anyone, somebody has to be willing to sell it to you. So if there's something on this stack that has a lower amount, it means that there's just not a lot of interest there. There's not a lot of people buying or trading those particular options, so there's low liquidity. So you always want to try to find something with the highest liquidity possible, because that means that one or two things: the spread between the bid and the ask is going to be very, very tight. The more volume there is. So now for multiple component options like spreads, like vertical spreads and iron condors, this is the same thing as well. because you actually have to have a decently enough volume, because you're executing more than just one contract. You're executing multiple contracts at this level. So what a vertical really is a vertical is that you're going to, if it's a call credit. Let's switch back to my whiteboard here. All right, there's a call credit, a call credit. So on the left hand side here, you see this is a call. These are calls. Now on the right hand side, this is puts. So this kind of mimics the exact same stack that you would typically see when you're looking at an option stack. On the left hand side, you got your calls. On your right hand side, you got your puts. In the middle, you got your price action, and essentially this mimics that whole setup right there. So you got your calls, you got your puts. Now, the types of spreads that you can potentially do. Okay, let's start with debit spreads. Now, debit spreads are over here, right here on the bottom. Okay, and what's a debit spread? Well, a debit spread consists of two different options. And the biggest thing about a debit spread, okay, is that on a debit spread, it means that you're buying the lower strike, at least on the call side, right? On the call side, you're buying the lower strike, meaning that if you are at, let's say you have a chart here and you're at this level, right? You're buying the one that's here, and then you're selling the one above it. So what does that mean? That means that this one here that you're buying at this level is, let's say if it's worth $100, right? The one above it is going to be worth like $90. Let's imagine that that's what those premiums are. And when you do the math there, you actually end up paying for that particular spread. To open that spread, the difference that you pay is the difference between the one that you sold and the one that you bought. So the one that you bought is $100, and the one that you sold is $90, and that's going to cost you $10. And that's essentially what debit really means. It means that when you're opening that spread, you have to pay to open that spread up, right? So all these options here on the bottom, the debits, these are essentially positions or for vertical spreads that you would have to pay to open them. And it's both on the calls and the put side. You have to do much the same thing for debit spreads, but they actually mean different things. For example, on the debit side, if you're buying a call debit spread, the expectation is that you're hoping on a chart that the price keeps going up, right? It has to go up in order for this debit spread to make money. And the reason for that is that the premium for the one that you bought is going to be more, or it's going to have a higher delta. And the higher the price goes up, you're actually going to see one or two things. So when you open up that first call, right? You have a call here, and then you have a call you sold for 90. What's going to happen is that as the price goes up on this equity, right? You're actually going to see this 100 turn into, like, I don't know, maybe 200, and then you're going to see this one here turn into 180. So now when there is a difference of 10, right? Now 80, 90, 100. Now there's a difference of $20, right, on that spread. So if you close that spread out, what happened? You open it for 10 and you closing it out for 20. So what you paid just doubled in price. And this is the biggest insulating factor when you're actually dealing with spreads, how it kind of works out. The price action, as the price moves up, will move slower, but your maximum loss is always going to be what you initially opened it up for. Instead of losing a whole $100 on one naked call, you actually end up, if this completely goes in the wrong direction and there's nothing you can do, you actually end up only losing $10, right? And I'll go through all the different risks and other areas here, but that's the whole idea with with call credit spreads is that you wanted essentially the price overall, you want the price to go up. Now, with a call credit spread, it's a little bit different because it's just the reverse of what we were talking about before. On a chart, right? You want on a chart for a equity to go down, right, or stay sideways, right? This is the main important part about call credit because there's two different operative things that can actually happen: go down or stay sideways. Now, what does staying sideways mean to the premiums? Well, in the example that we used before, remember we bought a higher strike than the equity was, and then we sold, right? We sold the one above it. So we bought the 100 strike and we sold, like, I don't know, the 105 or something like that, right? Now, in a credit spread, what you're actually going to see happening here is something a little bit different. In this situation, we're going to sell the higher strike, but um, we're going to buy the one above that. So, like, let's say in this case, you see how here below we bought the 100 and we sold the 105. We're gonna sell the 100. Oops. We're gonna sell the 100, and then we're gonna buy the 105. And why are we buying the 105? We're buying that one for protection, which means that if the price, excuse my chicken scratch, but if the price explodes up in a big way here, we're going to be in a position where we're protected by the call that's above that contract price, so we can have protection in case, and the loss will still be minimal, but the loss will still be the difference between the two strikes. So let's say the 100 was $100, but the debit the one I'm sorry the 100 that we sold was $100, and then the 105 that we bought was $90. So we have the difference is $10, and still the maximum value, might calculate, but it's roughly going to be around $10. What we don't want on a credit spread is for it to go up and above the price of the sold position. If it goes above the sold position, then we'll continue to keep losing money, and then there's always a maximum for what that looks like, right? So the operative thing is on a credit spread, we want it to stay down below where we sell it at. So for like Apple, if you're selling premium, you would want it right now. Apple's at what, like 101 something, maybe 150 strike. We would sell it way out of the money, and then if we sold that, or we opened that position at the beginning of the week, by the end of the week, we want that both of those contracts to expire worthless. And this is the best part about credit spreads, is that the sideways, if you open that position on Monday and there's a difference between the two contract prices of $10, well, if both of those contracts expire worthless, there's no intrinsic value, you will actually, on a credit spread, be left with $10 in your account if it doesn't go your way. But if it goes down, it'll be worth more. It could be worth $15, $20, $100, whatever the case may be. As much as as much premiums as you actually spreads as you have open, there's a multiplier effect there. I think there was a question here. Let me just make sure I'm on top of the questions. So if the max loss is $10, the max profit is also capped. That is correct. The max cap is capped in a debit spread when it goes up. The max loss, the max profit on a credit spread is also capped. It's capped at a theoretical number that's kind of out there, but it's really roughly the difference between the two prices. And typically, I'll show you this when you're actually doing this in your application, on your trading platform. In most cases, like if I switch this to vertical, in most cases, it'll actually tell you what your theoretical losses are here. See here in the upper right-hand corner, on the table here, it'll say max profit and max loss, and this is with 10 contracts. Let me just scale this down a little bit to 1. All right, so max profit on this particular spread would be $262. That's in the upper left hand, upper in the green, upper right hand corner. And then your max loss on this particular would be $51 actually. $51. Sometimes the numbers are a little wiggy after hours in this application, so don't mind that. Okay. All right. So now I want to get back to the let's get back on the put side, and I want to kind of show you something here. So now a put debit. What a put debit means is that you're buying a put, and your expectation is the price actually goes down for a put debit. Now, I want you to focus on the market sentiment here. On the credit side, this is you pay, and then I'll say you get money, right? So you always get a credit back. So if we open up this debit position here, the difference between it, if it was $10, we pay $10 to open up the position. On the credit side, at the very top here, right, on this row, see that? On that side, what ends up happening is you actually, whatever the difference is between the two sold options, you actually end up getting a credit. So if it was $10 on the top for the two different premiums, a difference of $10, you actually get $10 right back into your account. And for most brokerages, you actually have to have margin enabled on your account to be able to do this, because you're technically you're borrowing money from the broker, but it's kind of a good faith system, because so as long as you have margin enabled, you're using margin, but you're really only on the hook for the difference between the two spreads. And in case anything goes wildly out of control, then you're on the hook for that minor difference, instead of losing all of the premium, like $1,000, like for Tesla. You can potentially you can buy like a $10,000 single week contract on Tesla, but all you would be on the hook for is the difference between the two contracts. So if one was $10,000 and the other one was $9,995, you're really only on the hook for that difference between the two. And that's really one of the best parts about spreads. You're insulating yourself from all of this weird, especially in kangaroo markets. For the past 2 months or so, we've been in this weird back and forth kangaroo market, and that's why I was telling everybody for the past few weeks. I said, look, really and truly, spreads are the best thing for this kind of market. Okay, so now the sentiment, of course, on the debit is that you want it to go down, right, and stay down. And the further down it goes, the more money you make on the particular spread, because the values of those contracts keep going up, if you will. Now on the credit side, for puts, it's a different sentiment. You actually want the price to go up or sideways. All right, so same thing. Instead of it going down, you want it to go up, or you want it to go sideways. That's what a credit spread looks like, and that's how a credit spread makes money. All right, so these are the main elements, all for vertical spreads, and what the price action is, what the price sentiments are, and you can actually use them in different ways depending on what the equity is and what risks you think you're getting into. Like for example, let's use Apple as an example. We know that Apple's probably not going to go to $80 a share or lower, unless there's some real market sell-off, like we're in a major correction. So we could theoretically, right, sell put credits on Apple, from now until forever. If we know something is a strong company, it's never going to go down, you could sell a put credit spread on any equity that has the power to stay up, or has so much float shares that it's just going to keep either going up or going sideways for a long period of time. And every single day that passes, you actually get fatal loss on the contract that you sold. You'll lose money on the contract that you bought, but you'll also get theta loss. And so as long as the one that you sold is making more theta than the one that you bought, you're actually going to end up outweighing the amount of money that's being lost. And it's really simple math. And I kind of want to show you this too, because this is the best part about selling premium, is that it's really just simple math. It's actually going to help you get out of these things. So this part of the options I want to kind of show you and to give you a better visual understanding of what the components are broken down and how they actually work. So I'm going to turn back over to the PC here really quickly. Let me stop sharing from here and get back on the computer. All right. Share my screen. Desktop 1. All right, everybody should be seeing my desktop here now. If you are not, let me know and we'll go into it. All right. So what am I looking at here? Well, first and foremost, I am looking at, I'm in on-demand. And in the on-demand, you have the ability in Thinkorswim. Now, it looks very complicated and complex, but you actually have the ability to basically go in and select from the top of the menu any day back in history. Now, a little bit of it is a little glitchy here from there, here or there, but I want to show you something that I've been working on here, or a technique that I've been working on to actually get into trades, to actually get into trades without having to worry about risk. Because the biggest thing that keeps us from getting into trades is fear. Where, especially the last 2 months, I think a lot of people have gotten beat up. They've lost a lot of money. They have a lot of people have just been afraid to get back in the market because they don't want to. We've all been here before, where we get into something, and the minute we get into something, we're like, oh no, it's pulling back, or the whole market just kind of turns red, unexpectedly. Nancy Pelosi, Trump, this, that, all this politics, all this stuff happening, and it ends up hurting us because we're just in this thing to try to make money. And the repercussions of that is that we're in a trade, we jump into an option, and what ends up happening? Well, it pulls back. We either get stopped out. We get stopped out typically at a loss, when trying to set stops, or we end up it just reverses for the entire day, and then we end up losing money because we're sitting there and waiting for the premium to hit, and it's just not a good thing. All right, so I'm gonna pick a date. Let's go to the let's go to the 26th of October. I'm gonna pick random dates, and I'm gonna pick random stocks. And the reason I'm doing this is because I want to show you guys that this is possible for you to get into any trade without worrying if it's going to reverse on you. Now, and all the criteria that I actually use to get into those trades. So the first thing I want to do is I want to look at the option stack here, okay? And I typically always go out a week, in advance and look at, hey, what's playing, what's the volume, what's the open interest, and I'll pick something with high enough volume, high enough open interest. You know what? Actually, I'll do October 30th. Because notice that there's definitely more volume here on this column. There's definitely more open interest. And of course, the implied volatility was high this week because this was earnings week. Okay, so let's imagine that the bell just rang. It's the 26th of October. It's 9:30. The bell just rang, and we are waiting here to figure out, all right, well, which direction? What is it going to go in? Is it going to go up or is it going to go down? Should I get in or should I get out? Well, if you sit there and wait for the actual stock, you'll watch that it's. I'm waiting for this to pre-buffer. Of course, this always happens when I'm trying to do these trainings. It's always sitting there and buffering. So you'll wait for this thing to go, and you're trying to figure out market direction. Right? You're going back here. You're checking the market levels. you saw that the prior day, Apple was around 115. You figure, all right, cool. It has a potential to run up there. Somebody took a pretty high short position at 115 all the way down. So they thought that Apple was going down or was going to crash. So I'm going to just do the basic stuff that I always do, which is mark off those resistance levels. These are the things that I look at during the course of the day to try to figure out how I'm going to play the market for that day. All right. So I marked off the highs, marked off the lows. This is the range of what I think that Apple can run in from 113 to 115 ish. So if it's here, it's seemingly somewhere in the middle. This is VWAP, top of VWAP. That's bottom of VWAP. That's VWAP in the middle right there. So right now, Apple is trading in the low part of this range between yesterday and today. All right, I'm gonna pause it here. It's finally pre-buffered. Now, let's say I want to get into a trade here with Apple, but I don't know which direction it's going to go in, right? So if I think this has the potential to run back to 115, right, I'm going to give myself some buffer here on the stack. So the 115 is here, but it's too close to the money. So if this reverses on me, there's one major thing that I want to avoid. I want to avoid when you're selling premium, you always want to avoid a contract you're selling to have what's called intrinsic value. And when it has intrinsic value, um, there's a potential risk for the option to be exercised. When you buy a call, you're controlling 100 shares. Now, if you get exercised on an option that you sold, you potentially, will have to pay up a plethora of money, or you have to essentially hand over shares or the value of those shares, to the person that actually ended up, buying that particular option that you sold. But this is also why, with this technique, I want to make sure that when I get involved with it, I want to give myself enough space between where the actual price of the equity is, 113, and where the actual the entry that I'm going to get into. Meaning that if the money is here at 113, I'm going to give myself some space down here, high enough deltas, right? So I can make money, $25, and this is 51. This is not so much important with selling credit spreads, but this is buying a debit spread. So buying a debit spread, like let's imagine I want to buy this one right here, the 120 strike, because I think that while it might not hit 120, it'll probably get close enough to 115, but it's far enough away so that if it goes to 115 at this level, that if this reverses on me, or if I get into this 120, and if this trade reverses on me, right, then I'm only selling the 119. Now, I want you to look at these two prices right here. Okay, if I'm buying this 120 at $125, and I run into trouble, I'm going to want to sell the 141 for 141. I'm sorry, the 119 for $141, right? And if you do the math, the one that you're selling for 141 and 120.25, the one that you're buying, there's going to be a differential there because you're getting a credit for $141, but you're buying the one naked for $125, right? So that's what break out my little calculator here. So just so that nobody thinks I'm cheating here, 141 minus 125, is that what that is? 125 means that we end up with a credit of $16. So I'm selecting these two pairs right here, right? Because I think, and there's enough open interest on both of them, right? It means there's a lot of people with open contracts for this week. So I'm going to copy this guy right here, and I'm going to put this into my active trader stack, right? Control A, Control V, there we go. So this is the call side, or the long leg. I'm going to call that the long leg. And this is a short leg. In case I get into trouble, I can sell this one, for that little credit there, which means that if both options expire worthless, right, at the end of the week, if Apple pulls backwards, stays sideways, by the end of the week, and I'm hoping that this gets to the 120. If it stays below 120, or it goes higher with this particular spread, because I'm going to get into this, then I'm going to end up with a credit, because the one that I'm selling is not going to have any intrinsic value also, or shouldn't have any intrinsic value. Now, the best part about opening spreads is that when you open a spread, meaning you buy one, you sell one, you can close out either part of the leg, at least on Thinkorswim or TD Ameritrade. It lets you close out either end at any point in time that you want. So let's imagine I'm getting into this trade, and let me just see what happens here. Let's say Apple's at 113 right now, right? We just hit continue, and I'm watching what Apple's doing. I'm like, all right, cool. I'm waiting for the signal, the buy signal, if you will. Apple's kind of just stuck right there in the middle. I'm looking at the buyers. There's some bigger orders at the top here for buying, so it looks like it's getting some green. Let me jump into this really quickly. So I just jumped into there, waiting for it to fill. Come on, fill. Oh, wow. That's spike time. Okay, let me try that again. Buy. Okay, it just let me fill there. Sometimes on demand is a little wiggy. And usually when it's live, this active trader moves up and it tracks the price of the contract price more accurately. But on demand, for some reason, it's been doing this wiggy stuff where it's not really following that. So you'll just have to imagine that I'm following the chart here, 136. Right now, it thinks that the contract price is 136. Now 134, now 135. But usually like this bounces up and down and you see like buyers and bidders on either side. For some reason, it's just not doing that today. But let's imagine that, this thing is moving, the price is moving up here, and it's getting to, I want to get to the point where it actually goes up to the top and then it reverses on us. Now notice here on the right-hand side, as I entered here at contract price 135, once the market price updates, it's at 140, but like at 140, it would be up here and we would be up 30 bucks. Okay, so the price is moving up. Also on the left-hand side, you see that the volatility index is swelling at the opening of the bell, which is typical of all equities. I'm looking up here at the VIX. The VIX is going down. I see that the SPY is moving up. These are all good signs. These are my indicators, which tell me, all right, cool, everything's all right. But also I've got my finger to sell the lower contract at 119, the 119 strike, right? Which is currently market price is 172, and it's probably going to be higher. But if we sell that one, then there's going to be a net credit between the 135 entry and the 172. I'm also watching this area over here just to make sure that there's no big orders, because I have this sorted by order size of 1K or more. I can make that to 500. And also by the price up or down, because this will give me a visual representation of if there are any big orders, big sale orders coming in, so that I can actually say, oh shit, there's a big order of like 10,000. That means that damn equity is going down when those orders fill. So I need to get out. I need to get out ASAP. So I'm watching it here, and I'm getting ready to, I'm looking at this. This is looking like a bull flag to me here. But I got my finger on the sell button, because the minute that this reverses, if this reverses, if I'm not happy with what I see here on the left, and I don't want to, if it's only like 20 bucks and then all of a sudden I start seeing red, then I'm going to want to sell the lower strike as quickly as possible. And that's going to be my protection. It's going to insulate me from the downside movement of the call that I bought. Okay. Hopefully this is one of those days that I pick where Apple somehow just flats out reverses. But if it's not, we can go to another day, or we can fast forward until it does. All right, so now it's going up to this level right here, which is the pre-market high. I'm watching to see what it's going to do here. It potentially could break out. This actually looks like a decent breakout, a bull flag breakout. So let's see what it does. Sometimes it could be a false breakout, and then all of a sudden it'll start pulling back, and I'll start seeing red on the account on the left-hand side. So we're waiting to see what it does. Let me speed this up a little bit here. Use the fast forward button. So I want to get to the point and cut to the chase of what we're going to do if this thing reverses on us. All right, we're at 115. We're starting to see some red. I'm going to pause it here really quickly. So we're starting to see some red candles, but look at that range on that candle. That's a pretty wide range. Hit the play button here. It's teetering around 115. I'm starting to see some big red orders show up, clouding the green. You see the red starting to stack up here. More and more people are selling because they're kind of afraid. But this kind of looks okay. We're still seeing some steady green orders come in, some big 1,000, 6,800 shares, 3,000 shares, buys at the higher price points. People are buying more than they're selling here, so this looks good. I'm going to restart this to auto. Looks like it's running. We're up, like what? Where are we up? 151. Now, I'm going to pause it here for a second because I want to show you something. When we look for trades, what we're looking at is we're looking at trades that go outside of the boundaries, typically, of what we expect to happen. So all of this movement from this opening of the bell up here, all this area here was an area that we could have potentially made money. But because we wanted to be conservative, and typically in most of the breakouts or the breakout strategies that we follow, that says, hey, wait for it to get above a pre-market high over here to the left. It's typically we get into it over here because these are what are considered the breakouts, or they're just outside the boundary of what you would expect the actual equity to be. It shouldn't be above 115 pre-market high technically. So, and it's bull flagging all the way out. So we wait for confirmation. You remember, like every trader will tell you, oh, wait for confirmation, confirmation, because you don't want to get into something if it's not going to go. If it gets to this level up here and all of a sudden this resistance point, it turns around and goes back down red, then guess what? You got in over here, whatever, you got in over here, it went up here, it can reverse on you very quickly. And typically when these things reverse, they reverse quicker than they go up on the call side. So typically, when we're looking for bull flags and breakouts, we're looking to enter here. We're not looking to enter down here on the left-hand side. So notice how I jumped into this trade over here once I started seeing green and green and green. I ended it, what did I end it at? Somewhere over here, I think. Somewhere over here is where I ended, because I had like three green bars. I jumped in right over here, and I rode from here all the way up to the right-hand side. All the way up to here to the support. And look, my contract price on here has benefited from that because I entered here and I'm eating all the profit on the ride up. So I've got a much bigger, buffer. If I wanted to set a stop here, I can set a stop. I can say, all right, cool, let me set a stop here at 140, 146, and if the price slams into here, I'm guaranteed somewhere around this price of $55 to $50, or whatever the case may be, if I wanted to set a stop. But because because the way we typically trade, where we're up here, and then I have this other blanket of insurance, right? I can confidently keep this trade running to see how high it goes, and either close out the position with a much bigger buffer of green on the call side, right? Because if I were to get in here, now as you see, it's starting to reverse. it's starting to show red. And if you would have gotten in over here, then you might be right at the level of red or right at the level of making profit or breaking even. And that's not even enough money for you to, like, in some cases cover your commission costs, depending on what trading platform you're on. So here we're at 115.46, right? We got the 119 call ready to sell in case anything goes wrong. I actually want to see this reverse, but this is a bad example because it's not reversing on me. Come on, Apple, do what you do. Reverse on us. I'm going to fast forward this a little bit here. I want to actually see where it gets in and reverses. Seeing this is either another flag that's forming or it is going to reverse. Let's see what happens here at this level. 115, it's a top order. 115.439 is a lot of, there it is. All right, so look at the reversal right here now. I want to show you something really quickly before I even go into anything else. So on the call that we got into, we're up 18.15%. We're up 122.50. So we made money on this. Let's see. Let's keep playing it out. Let's see what happens if it pulls back hard or whatever the case may be. Fast forward, fast forward. Wait for this to do its thing. It's still going up. Wow, this would have been a really good day to trade Apple because it just keeps flagging up. Flag, flag, flag. Up, up, up. All right, so now look up here. The futures are starting to show some red. The SPY is starting to pull back. Something's happening here at this point in time. Maybe somebody tweeted something. Market, look at a SPY tank down now. SPY starting to come down. This is probably going to make Apple break this support right here and probably come back down. Parabolic indicators are showing okay for now, but it's probably going to reverse any second here. So let's say, yep, it broke. See, it just broke through support. Now it's falling down. Notice how, keep your eye on this line right here. This is the implied volatility. Notice the parabolic indicator is starting to curve forward. It's starting to curl over. Now, we could get out here, but I also want to show you what this is going to look like when we actually get to the point where we close this position at 115. Looks like it's doing a bounce, and this is the whole kangarooing of the market that I always notice on a day-to-day basis. It pulls down, it goes up, and this is the thing that kills stops, because even if you use the technique of setting a stop and moving the stop up, following it up, chasing it up, this is something that would slap into your stop and stop you out on an equity, and potentially it could hurt you or help you versus actually just sitting in the actual equity or sitting in the contract. You can see that the contract price is starting to pull back here. It was at 116. It popped up to 163. Now it's starting to pull back to 147. I'm gonna do something really crazy here because I want to make sure we get into there. So I'm gonna sell, but I'm gonna buy back, right? Now notice here we're at 149. We're down 20 bucks, but we're at 176. This is what I want to show you. So I just sold the other one at 176, and then if you do the math here, the 176 minus 149, right, on the calculator, we're actually going to end up getting a profit if both of these expire worthless. So 176 minus 149 If both of these expire worthless at the end of the week, and these are October 30th, we'll be left with $27 in profit. Okay. Now it's still pulling down. When you sell a contract, you're actually, when you're selling a call, notice here you're actually making money as the price goes down, right? And this is dependent on the delta, right, of the actual contract. I'm going to pause it here and I want to show you something here that's going to probably shed some light here on what's really happening. On this stack, it shows which positions that I've opened. Now we started out opening the 120 strike, okay? And the delta for that is 30 on the 120 strike. But the delta on the one that you sold is actually $4 higher. And for those of you that already know what the Greeks mean or what deltas mean, is basically the price action of the contract. For the equity, it's tracking in dollar amount. So if the price of the equity goes up $1 or down $1, this is how much money the premium is going to go up or down by. That's what the delta is. So if you buy Apple at 115 and then it goes to 116, right? And whatever contract you have, like this particular contract, if you would have bought it, it would go up by $34 if the price of Apple went up. If that price, $1. If the price of Apple went down $1, right, it would go down by $34, and that's what's dictating the actual the price of the contract. Okay. Anybody that jumped in, just make sure you mute yourself, please. Just check one thing here. All right, perfect. All right, so this is an important thing to keep in mind or pay attention to, because in a reversal situation, what this really means is that if the price reverses on this trade that we just got into, which it looks like it did, the implied volatility starts coming down or coming out of the contract. The value of the contract that we paid for, irregardless of when we paid for it, is going to go down in value. And the dollar movement, if you notice here, right? So each individual price change has a different numeric number, right? When it's 5, 10, 15, it's not much of a difference, but it's slight differences. You'll actually see it as it's playing out. If the price goes up, you'll lose money on the sold contract, but if the price goes down, you'll gain money on the right-hand side. The other thing I want to show you here is that the overall right now on this position that we have open here, we're down 32.50. But the other thing I want to show you here is that if we fast forward and go to the end of the week, even if we keep this spread open from now, which is the 26th till the end of the week, you know, at the end of the week of every contract expiration where contracts go to die, these $153 figures and $178 figures turn into $5 and $4, right? So at that point in time, when the contracts expire worthless, so as long as it doesn't go up into the contract price that you sold, and the contract price that you sold doesn't have any intrinsic value, right? Because you can break it at any point in time if you see it's reversing, but as long as it doesn't have any intrinsic value, you don't have to worry about the contract actually maintaining any value. It'll end up having pennies, if you will. Okay. Is there any questions on that part so far? Just want to make sure that taking a temperature here, you guys are good. Everybody's good? Okay. All right. So let's fast forward this a little bit here. I just want to show you where we're at with this. See if this is a good day for Apple or not a good day. I think we'll just go forward. Looks like it was a really good day for Apple. Oh, there it goes. Now Apple's starting to curl back over. I mean, for the contract price to actually update here, we're still pre-buffering on the left-hand side. So give this a few seconds to pull down this new data from the market servers. And again, like I said, the wherever the price of the contract is, you'll end up just doing the math between the two. So right now, if we pause this, I just want to see where we're at in terms of money. So on the one that we bought, we made 70 bucks, but on the one that we sold, we lost 80 bucks, which is a difference of like what, 10 bucks, right? So yeah, 10 or 20 bucks, whatever the case may be. So again, this is just kind of showcasing the operative action of the contracts that we bought and the contract that we sold. And if we fast forward to, I want to show you this really. I want to fast forward to like the last day of expiration. Right, the last day of expiration, these contract prices here are now $1.67. But then when we fast forward to the last day of expiration, I want to show you what these actual contracts are going to be actually worth here. In this case, we know that Apple pulled way back from these levels on Friday. Just waiting for it to pre-buffer. So on a whole, what does this mean? On a whole, this really means to you guys that you can be comfortable if you with your broker, you can get into a trade, you can convert your particular trade, your naked call. If you have a sense of direction, you get into something and reverses on you, you can sell with this technique a lower strike contract if you can convert it on your platform. And then if as it keeps playing out, if like let's say the following day you have like 10 days till expiration of the contracts that you bought. If by the following day um, you're in position, while I wait till this load, I'm going to share something really quickly. You're in a position. I need to stop sharing first. Looks like you're in a position where um, whiteboard. Let's say you open up Apple here, right? So it opened up at 110, right? And you bought a 115 call, right? This is the one that you bought. Bought this one here, okay? And it reversed on you. It went up to like I don't know, went up here to 114. Then all of a sudden, after 114, it hits this number, then it starts heading down, right? And you had because it went down, you sold here when it's reversed, you sold the 116, right? So you sold the 116 was less in value. Apple goes down or it goes sideways for the remainder of the week towards expiration. You're actually only on hook for the difference between this contract price and that contract price. So let's say it was 10. This one here you sold for 90 bucks. This one here you bought for 100 bucks, and this is the difference between the two prices, right? So at the end of expiration, this contract here is going to be worth, let's say it's worth, you know, this is zero and this is zero, like zero and zero. So the difference between those two prices would be 10 cents. In this case here, you would actually be down 10. And this is I'm sorry, you sold the 115, my mistake. You sold the 115 and you bought the 116. That's the other way around. Let me just go back here. Yeah, you get what I mean. Where is it at? Erasers. Here's my eraser. No, that's not eraser. Okay. So you bought the 116, right? And when it reversed here, you sold the 115. The 115 was 100 bucks in premium, right? The 116 that you first got into was 90 bucks in premium. And the difference between that is 10 bucks. So when both of these contracts expire worthless on the following week, you will actually be left with $10 in your account. So as long as the price doesn't go above 115, right? Because this is the one that you sold, the 115. Okay. Now, if the price, if you're expecting the price to go up, then you would reverse that. You would turn that into, of course, a um, a debit spread because your expectation is the price to actually keep going up, and you would make money that way. But this strategy is the strategy that I like the most because, and you can actually do this on the put side as well. What does that look like on the put side? It's actually rather pretty simple. So let's imagine that you were trading something. This is the price here, and you bought a put, right? So the price is going down, right? And here you ended up buying a put for, let's say it was 110. You bought a 105 put, 105 strike put, and the premium for that 105 was 90 bucks. Same thing. Move this out of the way. And the it reversed, started going back up. So once it reversed here, you actually ended up selling a put for the 104 strike, and that one was worth 100 bucks, right? So when both of those expire, you actually end up with a credit of 10 bucks plus 10 when they expire worthless. So as long as the price of the one that you sold, which is the put, the 104, as long as this thing doesn't go down to the 104 price and you don't have any intrinsic value. Okay, does that make any sense to everyone? The whole concept of this is that the biggest thing about this is you actually have to do this as quick as possible. When you're actually doing this, you actually have to have both. It's in your best interest when you get into any trade for a naked trade for you to, because that's the leg that you're going to make the most money in, because that's the first direction you think it's going to go, up or down, puts or calls. So you really want to be in a position where you think that you have both of them lined up. Let me make sure that um, stop sharing here, that you have both of these things lined up. You have both of the contract prices lined up, and you're ready to go. Like before I get into any trade, I make sure that if I think it's that Apple's going to go up here, that I have all of the prices in mind. I've looked at the stack already, and I said, all right, cool. If I'm going to get in here, Apple is going to be, I think it's going to hit 115. I'm jumping in at the 120 price, giving myself enough strikes difference so that if it reverses on me, that I can sell the one strike lower, which is always going to be valued more. You're always going to be able to sell typically the strike that's lower than your contract at a higher price and end up with a higher premium. And to showcase just that, look right here. We flash forward to October 30th, right? A few days, and this is the actual contract expiration date. This is the October 30th contract right here. And this contract that we paid hundreds of dollars for is now worth $2. And this contract that we sold is now worth $2 as well. And I said this is where contracts go to die, at the contract expiration date. They have absolutely no intrinsic value, right? We paid 100 and change for the first one, and we sold the other one for 100 and change. And look at their values right now, $1 and $2. This is all this is all they're worth because they're so far away from the money. There's no intrinsic value, right? There's absolutely no intrinsic value in the stack, so they're all gonna die out. And at this point in time, it's 10:31 in the morning. But when you get to the actual end of the day, close to like 3 o'clock, you'll see that even these values up here, they start getting, less and less and less, and nobody wants to even touch these contracts anymore. They don't even want to trade them anymore. So what does that mean for us? As we said, look at this. We actually ended up making money. Our P&L on these contracts is 100%. So we made more than we expected because what actually happened here? Well, what actually happened here is the long leg that we got into, even though that lost money, we made so much more money on the one that we sold, the short leg. We made $880 on this short leg. Even though we lost 755, we made 880. And when you do the math, the net math means that, we made $125 on the spread that reversed on us. These are tools that we can use when we get into every single trade. And I'm just surprised that nobody's actually even really teaching these things or sharing these trading techniques with anybody else, because what do? We get into a trade and everybody says, "Oh, just wait, hold it, diamond hands." Well, you don't need diamond hands for this type of solution. With this type of a solution, with these types of techniques, you can get into a trade. If it reverses on you, you can get out of a trade. Even if it doesn't reverse on you, like let's say if it does a small pullback, it goes to the downside and then it shoots back up, then you're insulated by the difference in price between those two equities. Just like how, and we'll track back day and day, but like these prices will actually fluctuate and go up or down. And you can actually, like, let's say if you get into something, it reverses on you, you're down $50, you sell the other one, you're freezing the price at $50. Because for every dollar that it's moving up, when you sell the other side of it, it's gaining money, right? So it's actually allowing you to freeze the price between those two price points so that you can make money on one side and then kind of give you a sense of direction. There's another technique. There's some even more techniques that you can actually do. If you break these legs during the process, so like let's say if I go back to when these contracts have more money value, let's go back to, I don't know, the following day, the 27 after we opened up these spreads. Right, I'm just going to wait for this the contract price here to adjust. Takes a few seconds on the man to pre-buffer. But like, let's imagine that the price here is fluctuating. Like maybe it went up one day or it came down or something. There's going to be a value on this contract up or down. It could be down one day, like right here, it's actually mentioning it's down $32.50, based on the positive and the negative between the two prices. You can wait until the value gets to the price point that you want. Like even if it's $20, it's so much better to be able to have the flexibility and the control to be able to close out the position at any point in time that you want. Right? We're at 32 down on Tuesday. Later on in the day it can go up or down, and it could go to a favorable number. But like let's say if you want to, like this 32.50, I'm waiting for this thing to update here. Come on, paused. So let's hit play. Does it have any intrinsic value? Okay, here we go. So we got some intrinsic value. No intrinsic value. Okay, so we got value here. Probabilities are up. Okay, so we're up on this call, 100 at 180, but we're down. Looks like $65 here. So we're up. Actually, no, we're up $20, and we're down 65 here. So like, watch this. If I wanted to cut this leg off, all I got to do is buy this one back. So I just bought back this leg for $65. If I think that Apple's going to run up, I can break that leg and then use this opportunity that it goes up, and then I can make money on this side as well. Or you could do the other one. If it's falling, you could sell it again and reposition yourself. It just gives you so much. Look, it's going down. So it's going down here. Gives you so many more options. So I'm watching this candle here. Let me zoom out a little bit. It's probably gonna bounce, bounce, bounce. Let's fast forward a little bit. See what she does. And this is the Tuesday, October 27th. Because it was Apple was doing a whole lot of weird stuff that week. Either way, it was going up, it was going down, it was doing some weird stuff. Let me fast forward and see if it broke this asymmetrical triangle. So I remember charting this out during the week, and this is why these lines are already here. This is the great thing about Thinkorswim. It just kind of, oh, look what happened there. So the volatility went up, and then it came down, and then the contract prices came down also. So like right here would be a good moment to get this is a reversal. We're at the money line. So if I sold, actually it's going back up. Let's see, 158. If I sold here, it'll be the difference between 158 and 189, and that's what I'm freezing. So by the end of the week, I would still have that amount of money difference if both of those contracts expire worthless. Okay, all right. I think I've probably beaten that one to death, but I think you guys understand the concept is basic math. Whatever you buy, the first contract you get in with, if you sell another contract that's higher value, which is typically one strike below on the call side, then there's going to be a difference there, a credit to you if both of those contracts expire. The worst case scenario is that it reverses on you, but even still, like if you entered a call at $100 premium, the difference of loss might be $20 or $10 or something silly, much smaller if it reverses on you, because now you have a buffer between like a sandwich of or a buffer between the two prices that you entered in with, that's going to keep your losses higher, lower, and then you have much more time to decide, well, where do I close this out at? So if I close out this trade, if I'm in this, like I sell right here, if I have a trade here and I wanted to close this out because this is now a spread, I can go to my broker, I can create a low closing order, which will sell the contract I bought and buy back the contract that I have, and buy back the contract I sold. And that's essentially what's going to happen there. You're going to end up coming out with money. Okay. The other thing I wanted to show you guys here, because I think I spent a lot of time on that process, but or that concept is the other types of spreads and what those spreads look like. So I'll go here and reset the account real quick. The other types of spread I want to show you guys and what they consist of, and the risk profile and the risk analysis of specific spreads. So in Thinkorswim, it gives you the ability to do a risk profile. So like, for example, if I wanted to buy, let's do a, not the trade grid. These are the spreads that we have available to us, and these are the types of different spreads that we can do. Let me show you the verticals first, because those are the simplest to understand. So buying and selling one. So if you sell this particular spread and you do a risk profile, here's what it's coming up with in terms of numbers. The maximum loss here to sell this particular spread would be $69, and the maximum profit would be $31. Now, if you decide to buy the spread, it would reverse those numbers, 69 and 31. Now, for this spread to work, and I'll show you what the analysis of this actual spread looks like if we analyzed it. Let me remove the other ones, because I probably had a few other ones in there. Do that one more time. Analyze trade. So typically, let me get into Thinkorswim is a pain in the butt sometimes. On demand is kind of wiggy from time to time. Okay, so this is what the analysis doesn't really work too well in on demand. So this is what the analysis chain looks like, or how you can actually analyze. And I want to show you guys what this looks like, because I think this is actually pretty important for you to assess what your risks look like when you're actually getting into these things or getting into some of these trades. For the most part, most of the brokers out there, they will give you some level of understanding what your risk is going to be for spreads. Um, so for a vertical spread, like let's imagine that we're looking at the November 6 contracts, and we think that Apple is not going to go above 115 all of next week, right? So because we think it's not going to go up, we're going to sell a spread, right? We're going to sell a vertical spread. Let's sell one against, yeah, let's sell one to 115 and 116 strikes. So we're selling the 115 and we're buying to 116 as protection. All right, this is the one, I'm sorry, this is the one that we're selling, the 115 and 116, yep. Which means that we're going to get back a credit of $15 per spread. Right? If I confirm and send that, it's going to show you that the maximum loss here, like let's say if it completely reverses and just keeps shooting up to 150 or something like that, your maximum loss is going to be 85, but your maximum profit, if it does not, would be 115. Your break-even price will be at the level of 115.50, right? But to analyze this, I want to show you what this looks like to help you understand the trades that you're getting yourself into with all this. This is what the chart looks like. On the bottom of this chart is the price of the actual equity. In this case, it's Apple. So this is the 110, 120, 130, 140, 150 strikes, or the price of the actual equity. And on the left-hand side, you have your profit graph. Left-hand side going up is how much money you can theoretically make. The left-hand side below zero going down is how much money you can theoretically lose. So you see here that as the price goes up on a call debit spread, the value goes up, right? So let me just make sure I'm doing it right. You know, the price goes down, the value goes up. Why is that showing that? Oh, I know why. Analyze. Let me remove that. Yeah, something is not right here. There we go. Analyze. Risk profile. This is kind of back to front here. It's not supposed to be shown this way. Okay, let's try this one more time before I reset the crap out of this thing. Trade. Analyze trade. There it is. Okay. Here we go. So this is the proper chart. For some reason, it just did some weird stuff before. So again, this is the price going down. As long as it stays below 114-ish, we make money here. This is the green, this blue bar right here is our profit line. Now, if the price goes above 114, we start losing money. See that? And that's what that chart essentially kind of means for us. This is what a credit spread, the model of a credit spread actually looks like. Now, if we were to reverse that, right, if we analyze the reverse of that, I'm going to clear this out. And I'm going to select to buy this. This is where we expect the price to actually go up on the call debit spread. So we actually have to pay for this. We're paying $15 to open up this spread versus the individual prices of those legs. And to analyze that, we would go here, we choose analyze trade, and this is what that looks like. As the price leaves this area and it goes up, the value of the contract goes up all the way up to here. Okay, to $85 maximum on this particular spread. Okay, so just want to familiarize you guys with what that actually looks like from a risk profile and even a probability analysis. You can kind of see the probabilities. These probabilities update where it thinks the price could potentially go from the current price of 110-ish, I think it was, yeah, 108-ish. Okay, so that's what a vertical spread looks like on risk profile or risk analysis. Now, the iron condors look a little bit different. What's an iron condor? An iron condor is essentially composes of four contracts, and those four contracts make money in different ways. So I'm gonna get rid of this one here. And the thing about iron condor is that there's two different profiles. There's buying an iron condor or selling an iron condor. Depending on the configuration of that actual iron condor, it means two different things. But I want to show you what buying an iron condor means. And first, I'm going to show you this based off of the risk profile. Typically, buying a condor means that you expect that the price is going to go wildly in different directions, and I'll show you what that looks like on the analysis, the risk profile, right? So if the price, let's say this is the middle of the price right now. If the price goes down, you make a dip of money if it goes down. But if the price goes up, you also make a peak of money on the top of that, right? So you're right here in the middle of the condor, which is a safe zone. But if the price goes in either direction, up or down, right, the condor will make money on either side of that particular spread. So you pay or you risk more for buying an iron condor because your maximum loss is $90, but you're kind of guaranteed if it's something that doesn't have like a lot of float, you're kind of guaranteed money in either direction if it goes up or down. Because especially if a stock has a high volatility, you'll end up making money either way with an iron condor. Now, if it's something like Apple that's been sideways for weeks, you probably want to sell an iron condor. And when you sell an iron condor, you're actually going to be risking a lot less money to make a lot more. So if you sell an iron condor for $12, your maximum profit on that condor would be $88. And what does that look like? Well, kind of looks like this, right? If it stays, actually, let me see. That doesn't look right. Close that out, close that out. And let's trade. It looks like this, okay? Means that the price must stay between or stay inside of the body of the condor, the body being 107 and 109. And the actual components of the condor are like this. The one that you're selling is the 108 and the 109. The one that you're buying for protection is the 110 and the 107. Okay, so I want to show you something really quickly on this. Show you a kind of a graph of what this model actually looks like. Stop sharing here. Zoom. Share screen. Start. All right. So you guys should be seeing the scratch pad. I'll go to photos. Oops, that's not what I was looking for. Library. Okay, there we go. This is a long iron condor, right? And essentially, like I mentioned before, you're making money when the price stays in the middle. On when you're selling, I'm sorry, well, this is a long condor. When you're buying an iron condor, it's making money on either direction. It's kind of a weird graph. Okay. And what does that look like when you're actually trying to open up this spread? Well, this is what it looks like. It's buying four contracts here. If you're expecting the contract to stay within this range, that's essentially what it's looking like. And if I wanted to sell this one, this is what the risk profile looks like on that one. And if I am buying it, it's the opposite. That's what the risk profile looks like on that one as well. All right, any questions on that spread? Any questions at all from the folks that we have here? If you have questions, feel free to just write stuff in the chat. If you have questions, I'll get a notification on that, or you can call it out on voice. We'll take a quick minute here for any additional questions, any areas that you guys feel you want to cover on the spreads. or any of the techniques that I've kind of laid out.
Is it best to buy the spread, like the call, the sell, and the buy at the same time? Or if you go into a naked one and it reverses on you and you buy it, isn't the difference going to be a lot greater at that point?
Yeah, so for reversals, which is why I mentioned you want to make sure that you do it as quick as possible. Meaning that, for example, if I get into a trade on in any particular option, right? So you guys can see my screen, I hope. Switch back over here. So remember when we got into those calls, what date am I on? The band. When we got into those contracts, we get into it, and if it reverses on us, like I just bought 5 right here, it's going up. But if it reverses on us, we want to get in. If it reverses, we want to sell that other contract as quickly as possible. Meaning that we entered it in 163. We don't want to wait until the contract that we have waiting for insurance to sell that to be below 163. Because if it's below 163 or whatever the operating price is that you're at, then there's not enough money for you to make. I mean, you'll still minimize your losses instead of you losing a whole $163 premium. If it gets to 150 on the contract below it, the strike below it, it'll just look, it's 158 right now. If it gets to 150 on the contract that you're selling, then you won't when those contracts both expire, if the equity pulls down all the way, then you won't get money back. You'll end up narrowing your loss, meaning you'll lose some money, but you'll lose less, right? So if you enter it in 163 and you sell another contract at 160, then you'll only have lost $3 at expiration, if that price keeps going down on that equity. Does that make sense, Pat?
Very good. Absolutely, that was perfect.
Yeah, perfect. And the some of the other things too is that you can actually use this method to convert some of the long calls that you're actually in to make premium. So I had the unfortunate mistake recently of buying a Tesla January contract, and it has a theta, amount to it that it loses. I think it was a January. Let's take a look here. CSLA. Everybody's been getting mussed up and down on some of these contracts, but I had the unfortunate opportunity of thinking the same thing that everybody was thinking, that Tesla's going to rally, is going to move up another 600, to 600. I bought a 600 strike price on Tesla, and it has a theta. Okay, so it means that every single day that passes, it's going to lose money. Now, here's the brilliance of this TSLA. The brilliance of this whole process is that if you have a naked call, you can convert those naked calls into spreads. And you can even use like a back end trade to make premium and close any money that you have lost on that particular position. So like right here, the theta loss on this is $15 a day, which means that since I open up this spread, I've lost roughly $15 a day every single day that it doesn't hit the price. There's no intrinsic value in the contract, so it's just going to keep losing money if it doesn't head towards 600. Now, if I sold the one below it, the 590, or anything below it, yeah, within a reasonable margin of error, then I'll be getting back $15 of theta, right? So if I had opened up the day that I opened this contract up, if I would have sold the 590, had I known that back then I would negate any theta loss that I would have gotten. But the other thing you can also do right? Because the theta loss would cancel each other out. It's basically like you're converting an option into a theta-less contract. But the other thing too is that you can also sell the 580, which is a theta loss of $16. So you're not losing that $16. You're getting that $16 back, right? So now, instead of you losing money, so as long as Tesla stays below 580, right, you're making one extra dollar every single day, and it can go up. Of course, if you sell this back, you're making more money by narrowing the gap, but you're essentially making more money back than you're losing. Now your spread is helping to make you money every single day in theta loss value. I don't know if that's insightful or helpful, but to me, when I started looking at the math, I said, well, shit, I'm down $400 on gold, or I'm down this amount of money. I need to sell this amount of theta from now till expiration to be able to recoup that loss. And by doing a little bit of simple math, you can say to yourself, well, damn, this is all I really need to do every single week to close that loss. And that's the last position you actually want to be in. Nobody wants to be in a position where you're losing money every single day, which is why vertical spreads are it's just one of the most amazing things to do once you actually understand the dynamics of what's happening here. It could really change your trading career. It could change the way that you look at these contracts instead of just getting into them and just sitting there every day seeing your account getting sucked dry, the value of these contracts getting lost. Now you're in a position of power. You're in a position where you can actually take charge. You can take control of your account. You can freeze losses on your account by looking at the values lost between and the theta loss, and so on and so forth. Does that help anybody's understanding? Anybody have any questions on that at all?
Does the same rule apply to what you were just talking about? Say you do the 600 and the 500.
Mm-hmm.
Could you buy the 600 and sell the 500?
You can buy the 600 and sell the 500. The only thing about that is that you don't want the price to go up, because just in the same way as the price goes down, the operative thing is that you would want to wait a couple of days. So you'll like this one is $24. So you'll make more money on this contract because it's valued more, right? It's a higher premium, but you'd want to be very careful about the price of Tesla running up, because if the price runs up, then some of that value could be lost, and that's calculated by the delta. It's a $24 delta. You really got to do the math. If Tesla's at 385, right, and Tesla moves up, let's say it moves up to what amount? Let's think about this. The 500. There's a $24 delta, which means that for every dollar that Tesla moves up, there's $24 that it will gain in value. But there's also $24 that it'll lose every single day. So let's say that there's 10 days. There's $240 that you're up because you sold this contract, the 500. You guys following me? It's $240 that you're up on. Now, that means that you really only have a buffer of 10 strikes. Yeah, you have a buffer of 10 strikes. So currently, the price of Tesla's 385. You have like until Tesla gets to 295 before you can safely stop out and not incur any losses on this sold contract. Does that make sense?
No, right. You lost me.
Okay. So remember when I opened up these positions? Actually, let me go back to on demand. So I opened these positions up, and it's up or down here, right? So we're up $85. I'm going to sell one here, all right, just to kind of showcase to you. at this point, if we freeze the price, if the price goes up on this equity, we have a difference of 153 and 188. Okay, so we imagine that this is the one that we sold. So, like, let's say we're deep, we're about $240. We're at this price level. We're $240 on the one that we sold at 240 on the right hand side. So we have, because the delta is 24, it means that if the price on this equity goes up $10, then we would have lost the positive value in this contract we sold, and we'll be back down to zero. Is that visually better? Better of an understanding?
Yeah.
All right. So because on the delta on that contract, the one that we sold was 24, wherever the heck it is, 500, 600. So if, for example, if we wanted to sell the 500, the 500's delta is $24, and it's 10 days have passed since we've sold it. So we've gotten $240. So we're up in value because the price stayed sideways, right? And the price on the contract, there's $240 that the person you sold this contract to lost on this premium. So you got a buffer of $240, which means that you really only have $10 of movement. If Tesla moves up $10 from wherever it currently is at these levels, then that $240 buffer, because of the $24 delta, would have been collapsed and wiped out, which means that you'll be back down to zero. Now, on the other side of that, on the one that you bought, you're going to make money, but you're making money at a lower delta. See that your delta is only $11. So there's a $240 differential, but you only made $110 on the one that you bought, because your strike is much higher, your delta is much lower. It's at 11. Even though your theta is 15, your delta is higher. So when you do the math, when you compute everything, and it all kind of adds up, for me, the most important operating principle when you're selling premium is literally how much buffer you have in between you and the contract you sold, or how much money value. So what you could do is you could set a stop at, I don't know, maybe $5 strike price down, or $5 movements up, back rather, on the sold contract. So that way you still get to eat, or still get to keep some of that premium, right? Because like right now, for example, like let's imagine it was at 178. You could still keep $45 if Apple, in this case right here, if Apple keeps going up, you bought back this position, you bought it, you can still keep some of that premium, some of that theta that the person initially lost in that contract, if that makes sense. I hope that makes sense.
Yeah, definitely.
All right, awesome. Now, again, the most important thing for dealing with this, or to making sure that you have all the concepts down. First and foremost, you need to make sure that your broker, for TD Ameritrade, for example, they require you applying for both margin. You need to be margin enabled for this to work, as well as you need to have what's called, I think, tier one, or I think it's tier two trading ability, which means that you can sell calls, or you can cover your spreads with your margin. So I think Robinhood is a little bit weird and different. You have to sign some kind of a waiver, but there's a lengthy process with going through Robinhood to being able to do this. So the important thing is to make sure you know exactly how to do this on your platform. So as long as you know what the operating principles are involved in doing this, in converting the spreads. Like, so if you're in a call, you sell the strike below. So as long as you have enough strike prices below you and on the money or at the money, you're doing so safely, right? You're trading safely. And so as long as that, by the time that the contract expires, both the contracts expire worthless. If you're doing a credit spread, that it's not close to the money, or there's no risk of the price slamming into the strike price of the sold contract. On the debit spread side, it's no problem because you can theoretically, if you're doing a debit call spread, it can go up and past it because the lower bought contract is always going to be worth more than the higher sold contract. You're literally just using the sold contract. It's basically like a debit spread or a ghetto spread. One of the other benefits to this is that you could really, really minimize your losses in terms of how much money you're going to spend. And I'll show you what this looks like here now. So like, let's say you want to be able to buy a contract on something because you think it's going to go up, right? Stocks always go up. Well, some of the most expensive ones, like let me show you Amazon, for example. I mean, if you have a small account, these things are some of these contracts are expensive. Look, we're talking about thousands of dollars. Like this right here, this is $15,000 to open up this position, and that's only from to November 27th. I can't afford that. Or I mean, do I really want to risk it? Is what I'm saying. If you have a lower risk tolerance, like you don't want to put up that much money on a naked call, do a vertical spread. Vertical spreads will help you in this manner because instead of you spending, all that money, look, that same contract price, instead of you spending $15,000, you're spending the difference between the bought and the sold legs. And in this case, it's $105. If you think it's going to go up, your maximum loss in this case is 105, and your maximum profit is 895. Okay, so what does that look like? Well, again, the analysis of this trade is that once I close out the other ones, let me see here. Keep forgetting to close out them. So the analysis of this is that if the price goes up, let's make sure I got the right one. The price goes up above your strike, your expected strike. You're going to start making tons of money above this leg right here, about 33.15. You're going to start to make like 800 $1,000, and if he keeps going up, then the price difference is just going to keep getting bigger and bigger, and you'll end up making money. So instead of making or spending $15,000, what would you rather lose? Would you rather lose $15,000 or $105 to potentially make 895 bucks? I don't know about you, but to me, I would potentially much rather spend $105 of premium, the difference between the two strikes, to potentially make $900. That seems like a much safer bet to me, at least. And on the reverse side as well, like if you think Amazon was going to go down, and you wanted to buy a put debit spread, you can spend 260, you can spend 513. There's all different prices here, price ranges that you can potentially spend depending on the difference in these contract prices to target what you expect to target there. Right. And this is just something, there's sentiments, sometimes there's benefits with going in any direction. Sometimes there's benefits where it makes more sense and it's safer or it's cheaper to buy because, again, remember the directions that we were talking about here. Directions that we're talking about. Let me share here. Start broadcast. Directions that we're talking about, the sentiments that we're talking about here, it all depends on which direction did you want to go in, where you think it's going to go. Is it going to go up with a put credit spread, or is it you think it's going to go down with a put debit spread, right? That down direction right here is what we're talking about. The sentiment, the market sentiment. Do you think it's going to go up with a call debit spread, or do you think it's going to go down or sideways with a call credit spread? And when they expire worthless, that you're going to be left with the credit that you had gotten, right? What kind of market sentiment are you looking at in the play? For example, is Amazon more than likely for earnings to go up or go down, right? That part right there could make all the difference between you being successful at spreads and unsuccessful. It's a sentiment of what you expect. So, going back to like this week alone, we had we had we had Apple, for example. We expected Apple to kind of rally after earnings. We expected, good things to happen. Well, in that case, when you were looking at Apple, right? Let's take a look at the stack, right? Not APL, APL, right? So looking at the stack, I can't do it now, but like looking at the stack, in some cases, it makes more sense from a risk profile or a risk standpoint. Like if I'm doing Apple vertical, look at the singles really quickly. So we do this one. So the 106 put is 199 bucks. The 112 call is 166 bucks. Okay. But like if we convert that into spreads, verticals, right? We end up doing like a 105, 106 for 50 bucks, 32 bucks here. What does that mean? We're risking 32 bucks for a potential to make 68 bucks. It's less than naked, but it's still safer because you're risking less. And then when you analyze, the risk, because put debit means that you expect for it to go down, but put credit means that you're going to get a $31 credit if it doesn't go down, but your max loss is $69, right? So what's worth it to you in this situation? Do you think Apple is going to go down and you're going to hold on to a $31 credit by risking nothing, or risking the 69 max loss on the credit spread? Or do you think that Apple is going to go up? So you're going to buy a credit spread, I'm sorry, a debit spread on the call side, and you're going to risk 28 bucks for potential to make 72 bucks, right? So when you get into all these different dynamics on the spreads, there can be benefits to doing it on either side, uh, in either direction. Like, so for example, selling this one, if you sell the 112 and buy the 113, right? And this expires sideways, there's two actions that can happen here, right? So if Apple never goes above 112 for the remainder of the week, right, you'll still come out with a profit because the contract that you sold is losing theta. So even if Apple stays sideways when you sell it, you're still going to make the maximum value in the credit spread. Now, if you bought the one, you're putting up 33 bucks and your loss is 33 bucks, but your gain is 67 bucks if it goes down, if it dips down. In this example, right, if Apple doesn't go down, you won't really make any money. You'll actually lose $33. But that's the same price action. The price action is the expectation for it to go down. This and this is the same thing. You're selling the call, you're expecting it to go down or go sideways. But this one, when you buy this one, it must go down for you to make money, right? That's two different actions. On the other side of that, if you sell this one, you are expecting this to go up. If you're selling a put credit spread, you're expecting it to go up, right? Because if the higher that it goes up, the more money you make with this spread. You're risking 69, you'll potentially make a 31 maximum profit, but it's a difference of a reverse price action, if you will. And all those, like I said, depending on what's going on with the stock, depending on what's happening with the equity, that could be the difference between you making a decision on picking a proper spread or the decision with you losing a little bit of money. Either way, with the spreads, you're going to insulate yourself because you're not naked. Does that make sense, everyone?
Yes, sir.
That makes sense. All right. Before I close this up, because we're running up here at, we started at 5, 6, yeah, man, we really cut through some time here. Before I close this out, are there any questions whatsoever on anything that we've covered here today? I know we're gonna put this up on the YouTube. We've been recording here, so on the other side of this, we'll put this on the YouTube channel. But before we close this up, we have a few more minutes to cover any questions at all from the general audience. I'll take it in chat. I'll take it on the mic. Whatever you guys got, toss it at me. What do you got? Anything?
So, like a newbie question, as long as it's in the money, you're not being charged theta.
You always charge theta every single day, even in the money. So if you look here, even the it might be less money, or it might be more. It really depends. So look at this. Look, some of these spreads actually make you money. Some of them actually charge you money. Like this one, you lose $2 here. This one, you get $2 every single day that it passes. You see that there's a difference there in the spreads. So that's also another operating. This is actually a great question, Pat. This is another operating component that you should really pay attention to when you're opening spreads, is the theta on the differences between the spreads that you're looking at. Some contracts will give you money, other contracts you'll lose money on the theta based on the subtle differences between the one that you bought and the one that you sold. But typically, you don't want to, if something reverses, if this is about a reversal, like you thinking that Apple was going to go to 120 or higher, and you sold the one below it, like the 119, you don't want the sold leg to be close to the money or in the money, right? This is why I always say give yourself like 5, 10 strikes in between you and where the money is in the direction that you're hoping to trade in. The last thing you want to do, okay, when you get into these positions, not saying it's the last thing, but like let's say you get into Apple at the 109 strike. If you sold the 108, if you sold the 108, the 108 would have intrinsic value of 52 cents. You don't want the sold leg to have intrinsic value, because the sold leg having intrinsic value means that there's a risk for exercising or you getting exercised. And you would have to buy, those shares, and you would lose money. It's just not a good thing to do. You want to make sure that you have enough breathing room from here to the contract that you bought and also the contract that you sold, just one strike below or two strikes below, whatever the case may be, that there's going to be no risk for the price to get anywhere near that sold leg, because you're hoping for it to expire worthless with no intrinsic value. Now, the one thing I will say with intrinsic value and being exercised on is it's very stupid for anyone to try to exercise a contract that has no intrinsic value, because if a contract expires, exercising it is not going to help you, because number one, you're paying more money to exercise a contract. In other words, if you buy a contract, maybe I'll explain it this way. If you bought a 114 strike contract on Apple, and Apple is currently at 108, and all week from here till expiration till Friday, the contract stays at 108. At expiration, it'll have zero intrinsic value, and that contract that you paid $115 will be worth pennies. It'll be worth pennies because that's what you're actually paying for, the intrinsic value at expiration. If it doesn't have intrinsic value, it's going to expire worthless, right? And it can't be exercised. But if it does have intrinsic value, it can be exercised. And not only can it be exercised, but it'll end up hurting you if you're the one that sold that actual contract. It'll hurt your bank accounts. So, and you can always close it out beforehand, but you don't want to be in a position. This is why I say give yourself room, like small scrapes. Give yourself room when you're getting into them. When I'm looking at getting into a trade, I give myself enough room. Like maybe this one here at the 114. If Apple runs up between here and here, here and here, I'll probably close it out because it'll move down 4 strike prices. This 25 will turn into 49 delta. So the delta will keep increasing as the price runs up to it. But I'll give myself 5 or 6 strikes for the price to move up. And then if the price moves from here to here, the value of this $115 contract is going to be $315. That's going to be more than double my investment. At more than double my initial investment, I'll be happy with that. If you go in with $100 and you come out with $200, you're happy with that, right? But if it reverses on you and it starts stepping away and going down in price, then your 115 is going to turn to 85 and 70 and 59 and 45 and so on and so forth. And that's your opportunity to sell the 145. I'm sorry, the 113 at 129, and be able to have that buffer, that difference. So if they both expire at the end of the week, you're still in the positive in terms of money. And the other thing to note is that, like I said, when you if your contract does have intrinsic value, because you're controlling 100 shares of any particular equity, not only have you paid a premium, let's say you paid $115 and then this is in the money now, right? But not only have you paid the $115 premium, or even if you bought this, let's say you bought this contract right here, you bought this in the money contract, it has intrinsic value, $370. You spent $370 for this contract. At the end of the week, it's still at $108. At expiration, it's still there, but you've lost $28 of theta per day, right? Even though it's worth 10 cents, you spent $370 to hold that contract for the option and the right to buy 100 shares of Apple at $108 per share. Okay? So if you exercise that contract, you spent $370 up front. If you exercise it, you have to spend money on brokerage fees to exercise that contract. And you still have to pay the price of 100 shares of Apple for $180 per share, right? So if you think about it, those are 3 additional costs that you have to pay to be able to own those 100 shares for $108 versus just buying 108 shares. I'm sorry, 100 shares at $108. It actually, pound for pound, it saves you more money to just forget about the contract if it's $108 and just buy 100 shares at $108 if you wanted to, because there's intrinsic value, but there's very little intrinsic value there. Now, this is why the intrinsic value starts going up higher and higher and higher the deeper you go into the money. It makes more sense to be able to buy 100 shares at $100 because you're actually saving money if you actually own that contract. Now, so this is why I say if you're somebody that's exercising shares or exercising contracts at the money, typically nobody exercises shares at the money because it's stupid. You're actually losing money by exercising shares at that level, at that line right there at the money. So typically, if you do get exercise at that price point, it's probably somebody that doesn't know what they're doing in terms of options. They think they can probably get money, or they're trying to figure something out, and they don't realize that they're actually spending more money than they would be if they just bought the shares. If that makes sense. Okay. Any questions on that?
No, sir.
All right, awesome. So I think that's it. I think I'll close it out there. We're again above we're well above the time here. The last thing I want to show you guys here is that our awesome feared leader has actually went ahead and start our website, stonkedup.com, and did a phenomenal job on the actual website itself. I certainly was amazed. We're going to start doing a blog here to track some of the stuff that we've been doing in terms of plays and some of the techniques that we've been doing. But also, there's some great merchandise I wanted to call out. some t-shirts,
merch.
merch, exactly. T-shirts, sweatshirts because it's getting a little bit cold. Some really cool stuff that we have here, and this is going to be it's pretty exciting for us because we're kind of just taking things to the next level. We've got the YouTube channel. I'll be posting all these training sessions and videos on the YouTube channel for your information and for your future reference in case you missed any of the things or you want to share any of these comments or any of these concepts, any of your friends or people that are interested in learning to get started in trading or trading options. This is where we're going to start. It's I think we've come a far way from where we started before in spreading the knowledge amongst our community, spreading the knowledge amongst our members, and really, instead of giving fishes, teaching people how to catch fishes from themselves. I think that's one of the reasons why I started this Discord with you guys, and one of the reasons that I do everything that I do is because I want you guys to be empowered to do this stuff for yourself, to understand the concepts and not have to be led blindly to off the side of a cliff or something like that with your accounts being hurt by it. So if I can give you guys the knowledge set, the power, the information that you guys need to empower yourself to make money in this kind of market or really any market, that's my thanks for everything else that we are doing in this Discord community. So I want to thank you guys for being part of this amazing community of people, and I want to thank you for joining this session today. If you guys have any questions, if you have any follow-ups, or you feel like we're going to be doing some sessions coming up in the next few weeks or so, I'll do a more in-depth analysis of some of the other spreads, and we'll be really cutting our teeth with some other areas of trading that we haven't scratched the surface of yet. We'll be getting into Forex trading and a bunch of different areas that you guys will be really, really excited for. I'm excited for anyway. I hope you guys are. So if there's no other questions, thank you so much for joining on a Sunday. Give some props, check out the website, stockedup.com. We're live and we're direct now with merch and all different stuff. We'll start to follow pretty soon. We have more crazy challenges. Give props to everybody else here that's been helping making this community amazing. And enjoy the rest of your weekend. Monday market starts tomorrow. We got a whole lot of catalysts, a whole new week of earnings coming up, nice and juicy stuff. And we will see you bright in the morning, early in the morning when we get our trades and all of our calls and plays put into the various different sections of the calls. Thanks so much again, guys, and peace and love. I'll catch you guys tomorrow.